The Federal Reserve announced that it's raising interest rates by 0.75 percentage point, following its November meeting, bumping the federal funds rate to a target range of 3.75 to 4%. It's the fourth straight time the Federal Reserve has raised rates 75 basis points, as the central bank rapidly reduces liquidity to the financial markets to help tamp down high inflation. The S&P 500 has decreased by more than 20% year-to-date, Nasdaq has dropped more than 30% while Dow Jones has down more than 10% this year. There is undoubtedly that fourth consecutive rate hike of 0.75% bring down the market. So, will the end of interest rate hike will the cycle of bear market? Or, is there other indicators that we can use to determine that the bull market coming to an end? Today, we're going to look at the checklist of signposts that published by Bank of America recently. These are the checklists to determine the bottom of the bear market. In other words, when the majority of the requirements are met, the bear market may have reached its low point and the bull market will soon start. Although we are unable to predict when the bull market will start, we can use this checklist as a guide to determine whether or not we are close to the bottom of the bear market. These 10 checklists don't need to be completely checked off when the market becomes bullish, though. For an example, the bull market in January 1974 came to an end after only 5 requirements were met. However, we can combine these checklists with our risk tolerance to determine our investment strategy. If 5 conditions are met in Q2 of the next year, let's say, investors with a high risk tolerance can start investing even though the market may still continue to decline. Conversely, when 7 or 8 requirements have been met, the cautious investors may enter the market. Now, let's look into the checklists. The first factor is Fed cutting rate, and obviously, it doesn't happen yet. Some investors think that the interest rate will raise until 5.14%, and even the Chicago Fed President Charles Evans thinks that the terminal rate should be close to 6%. In short, this condition will not gonna fulfill in near term unless there is some black swan event happen. When the market rallied in every of the previous bear markets, this requirement was met. The increase in unemployment rates is the second factor. This is due to the fact that when the unemployment rate rises, the market will weaken and the inflation will simply start to decline. This is also what the Fed desires. The current unemployment rate is still thought to be low, but historical evidence reveals that when a recession is on the horizon, unemployment typically rises rapidly. Investor sentiment is more negative than positive, which is the third indicator. A bull market is more likely to develop when more people are feeling desperate in the market. This is more psychological in nature. This was one of the requirements that had already been met. The fourth sign is an increase in equity risk premium of more than 75 basis points from the 12-month low. Equity risk premium refers to an excess return that investing in the stock market provides over a risk-free rate. This excess return compensates investors for taking on the relatively higher risk of equity investing. Stocks are generally considered high-risk investments. Investing in the stock market comes with certain risks, but it also has the potential for big rewards. So, as a rule, investors are compensated with higher premiums when they invest in the stock market. Whatever return you earn above a risk-free investment such as U.S. Treasury bill or a bond is called an equity risk premium. In short, when the market becomes bad, investors feel pessimistic and would like more reward when taking risk, then the equity risk premium will increase. This requirement is also significant because it has been met in every previous bear market. However, investors are not feeling pessimistic now since these conditions haven't been fulfilled yet. The fifth indicator is a 50 basis point drop in the yield on 2-year Treasury bills relative to their 6-month low. Because the Fed increased interest rates as part of its present monetary policy, it is unlikely that the 2-year yield will decrease. Therefore, when the Fed stops hiking interest rates or notifies the market that they will stop doing so, these conditions will be met. The sell-side indicator purchase signal is the sixth signpost. This is data from Bank of America. Thus, it is highly impossible that we as a retail investors can access. The method, though, is pretty straightforward. It indicates that the prerequisites are considered met when the majority of institutional investors begin to invest. The seventh signpost is yield curve steepens. This means investors are feeling optimistic for the long term. However, we haven't reached this phase yet. Currently, investors still focus on the market recession in near term. The eighth signpost is 5% bear market rallies, which we already went through this phase. The ninth indicator is Rule of 20. Rule of 20 refer as the sum of the P/E ratio of S&P 500 and the inflation rate equals 20. The stock market is undervalued when the sum is below 20 and overvalued when the sum is above 20. However, the current P/E ratio of S&P 500 is almost 20 while the inflation rate around 8%. So, there is still some time to fulfill these conditions. The last signpost is PMI improves. PMI stands for Purchasing Managers Index, and it is a measure of the prevailing direction of economic trends in manufacturing. The recent PMI is showing a downtrend graph. The improve of PMI need market reached the bottom of recession and the companies feeling optimistic for future, so this condition will be fulfilled. This might be the last things to happen. These are the 10 indicators we can look at to determine the bottom of bear market. However, we have only fulfilled 2 conditions and seem like have a long way to go. If you have other opinions, let's comment below. Please help to like and subscribe.